Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. President Trump threatens to raise the tariff on Indian goods substantially over Russian oil purchases. New Delhi slams the move as unjustified and unreasonable. Aramco's profit is expected to drop on lower prices, while refining margins may improve. The energy giant reports within the next couple of hours alongside BP. Plus, South Africa is turning to other markets to boost trade ties and is planning an aid package to support domestic businesses as U.S. tariffs bite. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, let's take a look at how these markets have fared because once again, I would say my own trading radar was wrong. I thought yesterday was going to be a down day for U.S. equities. That wasn't the case. We actually saw the strongest rebound for the S&P going back all the way to April. So Friday, we had the worst day since May. Yesterday, we had the best day since April. Very difficult to decipher the volatility in these markets. But essentially, what you are seeing is these futures are trading up in the green today, up 15 basis points. It has been a strong earnings season, and the markets are quick to price in further interest rate cuts out of the Fed. Taking a look at 10-year yields, we moved about 2 basis points lower yesterday. But the market is pricing in 60 basis points worth of cuts by the end of the year. This was sitting at around 30 before that jobs print on Friday. European markets also in focus today. We had a better day yesterday, actually ended up in the green as well. Today, looking like we're going to get a better start to the day, too. This on news in the afternoon that the EU are looking to perhaps delay the imposition of the counter tariffs on U.S. goods by 6 months. So buying a bit of window of time, perhaps to carve out even more concessions on that U.S.-EU trade deal. So something to think about there. And then Brent in focus after that OPEC Plus decision of the weekend to bring extra barrels to market. We didn't see a lot of movements yesterday. We, at one point, were trading firmer on the day, slid back a little bit. Again, still concerns about global demand, the outlook for the global economy. What I will say, though, is today is going to be a big day on earnings front. We get results out of Aramco over here in the region, and we get results out of BP. So two big oil majors reporting earnings. So stay tuned for that later today. All right, let's also move back and check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. Avril, I mean, deservedly so. There's a lot of focus on the Indian markets today.
Yeah, we're seeing that playing out in the Indian rupee because of the threats from Trump for substantially higher tariff rates. And don't forget, we also have an RBI meeting tomorrow. So we are actually at record lows, I think, on the Indian rupee. But aside from that, tracking the Chinese renminbi as well, we did get some data that showed an unexpected jump in services activity to the highest in a year, though it is quite unclear still whether this represents consumer sentiment turning a corner because this is a private reading. We're talking about the S&P global PMIs for services, and it kind of contrasts still what we got from the official reading. Aside from that, though, the rest of Asia, particularly tech, is more or less tracking the gains we saw on Wall Street, the Fed cut bets, and the dip buying that was underway in the US overnight. Jumana.
Avril, thank you so much. Avril Hong in Singapore. Well, President Trump did say the U.S. will raise tariffs on Indian exports over the country's purchases of Russian oil. India's foreign ministry calls the move unjustified and unreasonable and says its energy imports are a necessity. Bloomberg South Asia economy editor Ruchi Bhatta is with us. Walk us through exactly how much of an impact this could have on the Indian economy should the U.S. go down the route of higher tariffs.
This is going to, be a massive hit for the Indian economy. In fact, initial estimates suggest that from the 25% tariffs alone, that could shave India's growth by as much as 30 basis points. And remember, we did see a good growth of, around 8% in the last few years. But this year, the expectation is that the Indian economy will slow down considerably and grow at just about 6.5% as per the RBI estimates. And shaving off growth by another 30, basis points from here on would mean a substantial hit for the Indian economy. Having said that, not just that, remember, Donald Trump has also spoken about secondary sanctions on India. While he has not, defined how much this additional penalty is going to be, this could mean and this could come in as a big hit for India. Having said that, this is also coming in the backdrop of the RBI meeting that is underway. The decision will be announced tomorrow. And in fact, to prop up India's growth, the expectations have drastically shifted from a pause in rate cuts after almost 100 basis points of cuts that the central bank has done since February, to many economists now saying that perhaps the central bank should consider another quarter point cut that would give a boost to the Indian economy ahead of the festive season.
Yeah, and certainly the weakness in the USD allows for that to happen. Ruchi, what is the sense that you're getting just politically on how Modi is handling the situation? Because so many leaders around the world have approached the relationship with the U.S., the relationship with President Trump in differing fashions. Some people are sort of pandering to Trump's ego. It does very much seem to be the case that Modi is actually standing quite defiant. Does he think the strategy is going to pay off?
Absolutely. Prime Minister Narendra Modi has shown a lot of defiance. In fact, Indian officials making it very clear that the U.S., and in fact, Donald Trump saying that India has been buying a lot of Russian oil. That statement itself is completely unreasonable and unjustified. Remember, the demands of the Indian economy are huge. India is a net importer of crude oil, and which is why it is imperative that India buys cheap oil, because you have 1.4 billion people in this country that you have to really, cater to. Having said that, to really push an economy of this scale, you will have to, you will have to buy cheap oil if that is what is needed. But having said that, how long will this strategy really pay off is something that we'll have to wait and watch out for. Because remember, this is coming in at a time when the hopes were very high that India will be able to sign a trade deal with the US as well. And forget a trade deal. At this point of time, we don't have a trade deal. We don't even have, an idea as to what these undefined penalties would be on India. And on top of it, there is a Quad meeting that we were expecting that would happen in the month of September. There's no clarity on that as well. So these are definitely, tough times. And whether this is going to push India closer to China is something that we'll have to wait and watch out for.
Yeah, so many broader geopolitical ramifications. Ruchi Bhatia, thank you so much for the report there. Our South Asia economy editor. For more on how markets are reacting, joining us now is Anita Krishna Gupta, CEO at Wealthbrix Capital Partners. Well, actually, it's a great day to have you on because you were just in India. You were telling me that you got back recently. How is the mood on the ground? Quite simply, how are people thinking about what is going down now between India and U.S.?
Good morning, Jomana. The mood on the ground actually is pretty positive if you're looking at what's happening with the consumer, what's happening with industry. Everything in India seems to be buzzing in terms of consumption at this point, whether it's the offtake of automobiles or consumer goods. India has been on a big runway of growth in terms of adoption. We've got great internet penetration out there. Yeah. We've got, again, a very digital economy in terms of banking. Now, in terms of the mood as far as trade goes, there's a lot of rhetoric out there in the press and the media. But if you look through the headlines, which is the same with most countries, you do have, at this point, Apple iPhones exempt. You've got other electronics exempt. Apple iPhones doubled. It was about a $6 billion shipment last quarter. So if you do have certain goods exempt, it's a bit like Brazil where orange juice is exempt. So you have to read through and see the final impact. And I think it's difficult to calculate if it's going to be a 0.3% impact on GDP or lower. Yeah,
that's a really good point on exemptions. What do you make of the underperformance of Indian equity markets this year versus other markets?
Equity markets have had a great decade. Some of that taken away by the weaker INR. So you have always had the fact that in dollar terms, India has performed lower than what it has done in local currency terms. And that is a problem with a lot of the emerging markets. So in terms of the forward-looking, what we see India doing, you've had earnings growth, which was somewhere in the 20% per year on-year growth. And that's coming down to around 15%. So I think at this point, it's a little blip. On the strategic allocation, we would stay overweight India. What we're looking at is the longer term. We're looking at consumer, we're looking at banking, we're looking at consumption, we're looking at a growing middle-class population. And I think that India is also very much more transparent than other emerging markets like China.
what do you do with the currency? Do you hedge it or do you stay long the rupee if you get involved in Indian stock markets?
Costs of hedging are always the same as the currency depreciation usually. So we would stay long the rupee at this point. The dollar's had a good run in July.
Okay. Let's turn to broader markets. I started this show saying I was a little bit surprised to see markets reacting so positively yesterday. I would say a leading reverse indicator. I was telling my husband on Thursday that this market wants to rally, and then we had the worst day ever, since May on Friday, and then obviously things flipped around over the weekend. Why do you think the markets shrugged off all of the news about the bad data on Friday, about Trump firing the BLS commissioner, about the new governor, the Fed governor stepping down? Why was the reaction actually positive when we walked in Monday morning?
Very simple. Rate cuts are coming.
Is that
That's it. It's the expectation that finally September's expectation of rate cuts is somewhere around 82% now. So it's been growing. We're expecting at least 2 rate cuts this year. So I think that is now becoming a necessity. Of course, you've got sticky inflation data.
But at some point, doesn't the market have to distinguish between cutting because the Fed is going down the path of insurance cuts versus cutting because the economy is in a really bad shape and therefore things are about to get a lot worse in the real economy?
Economy is still not in a bad shape, I would say, but going forward, there is going to be an impact of tariffs. You've seen the automakers screaming about that, the impact on their profits. You've seen Ford, GM, not great results. So, yes, the economy is going to start ticking downwards. The last GDP growth number wasn't bad, but I think the Fed will have to look into the future and see, is there going to be an impact? Is hiring going lower? Is, the economic growth going to come down?
The thing that you mentioned about corporates in the U.S. is the margins are holding up. And so I wonder if in coming quarters, because of the tariff impact, companies will have to start bearing a bigger cost themselves. If that does happen, how can this performance of the S&P continue?
So currently, the S&P 500, 66% of the companies that have reported, we are seeing net profit margins of about 12.7%. That's the same as the last quarter, as higher than the last 5 years. Now, so far, they've not had the impact of tariffs, but we haven't had tariffs so far. If you're looking forward, you have seen consumer companies like Procter & Gamble come out and say they will pass on some of the cost to the consumer. So consumer companies have lower margins. They really cannot absorb too much of that cost. Tech companies have higher margins, almost 30%. So they can absorb the cost of tariffs. So there'll be a mixed bag as to what costs are passed on, what's bearable.
Hence why the Magnificent Seven trade rages on.
Yes.
All right, good place to leave it. Thanks for the chat. Anita Krishna Gupta, CIO at Wealthbrix Capital Partners. Well, Texas Governor Greg Abbott has ordered the arrest of Democratic lawmakers who left the state to block a vote on new congressional maps. Republican lawmakers proposed a redistricting plan last week that Democrats describe as a gerrymander. Meanwhile, Missouri Republicans are also considering a redistricting plan that President Trump pushed to bolster chances for the party to maintain control of Congress. And coming up, Saudi Aramco is set to report its second quarter earnings. A closer look at how the world's biggest oil company has been performing this year. Next, this is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Analysts expect a decline in Aramco's second quarter profit, driven by lower oil prices, overshadowing gains from higher production. The Saudi oil giant ramped up output in June, exceeding its OPEC Plus quota to help cushion the impact of weaker crude prices. But of course, that was around the time of the Iran-Israel war as well. Saudi Aramco shares are also the worst performing amongst its peers, slumping 14%. While Western oil majors saw a rebound in their stock prices, and that is over the course of this year. So we're just speaking year to date. Joining us now is Bloomberg's Middle East energy reporter, Anthony De Paula. So what are you watching out for today? Lots of moving parts. We had that ramp up in production in June. Obviously, oil prices lower, margins possibly better. Put it all together for us.
Yeah, what we're looking for is there's going to be a weaker second quarter because of the lower oil prices, plus still that lower production. So we did have that jump up in June, which was that month. But really, a lot of the news and a lot of the things that we've been talking about was this OPEC plus increase in terms of production. The bulk of that is going to come in August, September. So Aramco's still got that coming. So they've still got that potential uplift depending on where oil prices are. Aramco's been saying they can unlock this tens of billions of dollars if they're able to use some of that spare capacity. Of course, Aramco always keeps a little bit of a spare cushion there, but they do want to increase. So we'll expect to hear something about how potentially, even beyond the second quarter in August, September, how that bigger OPEC quota may help them. Plus, Nasser said in the last earnings conference call that they would update on CapEx. So we know that they have pulled back from that 13 million barrel a day capacity plan last year. A number of the oil field increment plans that they do have in place are finishing. We reported last week, on the drop in the number of active oil rigs there as they finish some of these projects. So we'll expect to see an update of CapEx maybe going forward from next year. We'll see if that's reduced or what they do with that.
What about the dividends? It is 2% obviously of the stock that's free float, important for international investors, and obviously their major shareholder, the Saudi government. What are we expecting there?
Yeah, that dividend is obviously a key talking point. It's a big dividend, more than $21 billion for the base dividend, and a tiny bit of the performance-linked dividend, they call it, which is based on the extra free cash flow. That's set because they're basing it on earnings from last year. So we're not seeing a huge amount of uplift from that. But what we're going to be watching is the free cash flow, because that's what they use to cover the dividend. Last quarter, they didn't cover it. This quarter, it doesn't look like they will cover it again. So that increases the indebtedness, which Aramco has said is not a problem. In fact, the CFO and CEO have told you that they plan to increase debt as well. So we might see some more discussion around potential bond sales. And then the state also has a potential share sale in its back pocket.
Yeah. Let's talk about the introduction to you, which is the fact that the stock is down 14% year to date, has underperformed some of the other international oil companies. How much of that is just a reflection of the Tadawul itself being one of the worst performing stock market indices worldwide? I mean, Aramco is essentially, an important cornerstone of the Saudi stock exchange. In a year where the Saudi stock exchange is down so much, doesn't it also naturally follow that Aramco would be down as well?
Yeah, so the exchange is weak for a number of reasons. This came up with talking with investors and analysts when we were reporting that story. So the exchange is weak. The dollar has weakened. So perhaps investors are looking at emerging markets, economies that are not linked to the dollar to get some of that uplift. So that's perhaps not helped them. What was interesting, though, is that Aramco has even underperformed the Tadawul. And for us, the more interesting comparison was that they underperformed their peers among international oil companies. So the international oil companies have seen an uplift in their shares, whereas Aramco has gone down. Obviously, Aramco, massive dividend, massive net income, but those other companies right now, Exxon showed record production for the last 25 years. BP is increasing production as well and announcing new discoveries and new startups. So what we're seeing is that investors are looking at those companies that are showing immediate growth paths in terms of their move away from green and back into oil and gas production, whereas, as I said earlier, Aramco is completing some of its expansion projects, backing away from that 13 million barrel a day capacity expansion. So investors are looking a little bit more for that growth uplift from the IOCs.
Perhaps we'll get some answers on the earnings call later today. So the earnings are out in just over an hour's time. Anita Krishna Gupta, our Middle East energy reporter, thank you. Coming up, Ghana's currency appreciation limits the government's ability to raise pay for cocoa farmers. We'll explain why next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. Ghana has raised the amount it pays farmers for their cocoa beans by 4.2% as the local currency's appreciation limits the scope for a bigger increase. For more, Bloomberg's Ndiro Ganga joins us now. Ndiro, I just took a look at how the cedi has been trading against the dollar. 40% appreciation in the last few months. What is going on there, and how is it impacting this decision out of the government to limit how much they're paying to the cocoa farmers?
Hi, Jumana. So since President Mahama took power basically 7 months ago, there have been a couple of changes that have been made in government to enable the cedi appreciate 40% this year in comparison to a depreciation of 20% next year. And some of these decisions include tighter monetary policy stance. We've also seen fiscal consolidation. They've cut down on spending and also drastically reduced the huge borrowing appetite that the previous administration had. We've also seen improved market sentiment. And then you have commodities like gold that are doing well at the international market, which is fetching them really good returns. And we've seen their reserves rising. As a result, the currency is strong. Inflation has gone down 18% in May. And this should be good news, but it's not technically good news for farmers, because while President John Mahama promised 70% of the total market price of what cocoa is being sold at the international market, these prices were announced vis-a-vis the dollar, and you peg it against the dollar, it's 68% increase. But if you convert it to the local currency, that's where the real scoop is, because farmers are saying they're only getting 128 cedis per bag, which is technically 12 bucks. And for them, it's not good enough. 4.2% is not necessarily good enough for them. And they feel like they're missing out. You have the head of Cocoa Board, Dr. Randy Abe, saying that if you had pegged this to the November price of the cedi at 16.5, this would have been good returns. But because the cedi has appreciated a lot, it has eroded some of those gains. And this now opens up the larger conversation of farmers could begin smuggling out their beans if neighboring markets offer better returns.
Yeah, and also puts the pressure on them perhaps to hedge some of that harvest in the future. Speaking of the harvest, it seems like we're heading into another disappointing cocoa harvest for much of West Africa. Why is that the case?
Jumana, there are several reasons towards this. You look at whether delayed rainfall in Nigeria and also strong winds is going to affect the production output that they're going to get. Then you have structural issues in Ghana and Cote d'Ivoire. Their trees are aging, their disease and swollen shoots, blackboard, and this is going to affect the total output. It's being put at a shortfall of about 40,000 tons, because if you compare the two largest producers in the world, Ghana and Cote d'Ivoire, production is going to be just slightly above 2 million tons, which is not necessarily good enough. And you have experts predicting that prices are going to be about 5,000. JP Morgan puts it at 6,000, and Citibank is predicting at least 7,000 by next year. This is despite the fact that there's weaker demand for cocoa, but it's not enough to subdue the prices.
Very interesting reporting. Bloomberg's Ondiro Ganga in Kigali, Rwanda. Okay, let's take a quick look at equity futures. This is how we are shaping up. It looks like it's going to be another positive session, building on from gains from yesterday. Who would have thought after all of the weekend headlines? But coming up, South Africa's government is finalizing a package to support businesses vulnerable to U.S. tariffs. So we're going to talk more about that with all the details next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. President Trump threatens to raise the tariff on Indian goods substantially over Russian oil purchases. New Delhi slammed the move as unjustified and unreasonable. Aramco's profit is expected to drop on lower prices, while refining margins may improve. The energy giant reports within the next couple of hours, along with BP. Plus, South Africa is turning to other markets to boost trade ties and is planning an aid package to support domestic businesses as U.S. tariffs bite. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, a day of gains yesterday for Wall Street, with the S&P seeing its best day since April after seeing its worst day since May on Friday. So a really roller coaster, a lot of volatility going on with these stock markets. But bottom line is a much better day, and pairing a lot of the losses that we saw towards the end of the week last week. Today, S&P futures also leaning towards the green, up 15 basis points as we speak about further interest rate cuts that are priced in to the front end of the U.S. yield curve. 2-year, 10-year is what we're showing today. It's 4.20, but even the front end has rallied so much so that the next couple of months are actually pricing in 60 basis points worth of rate cuts out of the Fed. European markets also seen opening up in solid territory, up 15 basis points. This after news emerged that the EU were thinking of delaying the imposition of counter tariffs on U.S. goods by 6 months. So again, positive news there, perhaps a de-escalation in sight. building up from that EU-US trade deal. And then Brent, keeping an eye on that too. We're trading just shy of $69, about 0.2% weaker. Today we get earnings from Aramco and BP, so watch out for that in the energy space. Now, South Africa's government is finalizing a package to support businesses that are vulnerable to U.S. tariffs as it continues talks with Washington on a new trade deal. The government also plans to seek new markets for its goods to offset the impact on its exports.
The U.S. accounts for 7.5% of our global exports. Thus, we will continue to engage the U.S. with a view to conclude a deal that advances the interests of both countries. South Africa seeks to conclude deals that promote value addition and industrialization, rather than extractive relations that deprive the country of the ability to beneficiate our mineral wealth by mimicking extractive colonial-era trade relations.
Our Chief Africa correspondent Jennifer Zabazaja joins us now from Johannesburg. Jen, it's interesting that countries around the world have had to come up with these contingency plans to deal with the likely impact that the tariffs are going to have on their economy. What do we know about the details of this package being put together by South Africa?
Right, Jumana, and I think it also really indicates just how much there's concern that's setting in with a number of these countries, especially here in South Africa, to some of these punitive damages. So we were just hearing there from Ronald Lamola about some of the precautions that they're actually trying to put in place for some of the businesses. You were mentioning there the package. Our understanding is that, yes, they are putting together the final touches of support for businesses who have usually and traditionally been able to export to the U.S. markets because there is real concern about what this then means for their own businesses here. And this package is going to be coming in addition to what we heard last week, at the end of last week, which was an export support desk that was actually launched by the Department of Trade, Industry and Competition to help come up with urgent interventions for a number of these businesses that are also concerned about the effect of these tariffs. Now, what we did get from the president over the weekend on Sunday into Monday is that he does say that Pretoria continues to engage with the U.S. They're hoping that at least some of the proposals that they've put forward, the U.S. will come to the table because they do see, as we were just hearing there from Ronald Lamola, they do see benefits for both countries. The U.S. is South Africa's second biggest trading partner, second to China, if we're talking about countries. And we've done stories in particular on the citrus industry here that a lot of U.S. consumers have relied on South African citrus. They're counter-cyclical. And so it's not necessarily damaging any of the businesses from the South African perspective of any American industries. There's also concern about the automotive industry here really being hit, that leading to 100,000 potentially jobs at risk. And so the government is really stepping up what they see as a number of measures if, in fact, they aren't able to get the U.S. to the table. And a lot of analysts, though, do say these measures are important. But even if we do see more regional interaction, which we have seen a number of African countries point to the fact that they do want to trade more across the continent, it doesn't necessarily replace a U.S. consumer. You can't sell necessarily South African wine to regional consumers in the way that you can to U.S. consumers. So there still is very much a real concern about the long-term effects of what 30% tariffs could mean for an economy like South Africa.
For sure. Jennifer Zabazaja, our Chief Africa correspondent in Johannesburg. And for more on how tariffs are going to impact Africa, we're now joined by Matthew Ryan, Head of Market Strategy at Ebury. Good to have you with us. So my colleague Jennifer was just walking through the package that South Africa are putting together to help perhaps buffer or provide a cushion to those producers, those consumers that might be affected by those tariffs that will be likely imposed by the United States. What does it look like for other African nations? Will they also have this fiscal cushion to help remedy the effects of the tariffs once they eventually hit?
Well, I think it's worth mentioning right off the bat, I think the impact of these tariffs on the African economies are going to be quite varied. So it's going to be very much dependent on the tariff levels themselves and, of course, their exposure to US demand. So actually, while we do have a situation whereby some of these African countries, we think South Africa being one of them, Kenya another, that are either faced with high tariffs in the case of South Africa, or highly exposed to US demand in the fact of Kenya. A lot of them actually are relatively isolated from the tariffs, particularly those that are highly dependent on the exports of oil, minerals, for instance, that are excluded from the tariffs. When it comes to how to deal with these tariffs, of course, it's going to be a challenge. You talked about the possibility of increasing intra-trade within Africa, which is a possibility because only around 15% of intra-trade in Africa versus 60% in, say, Asia. So there is a scope for more trade within Asia to counter that. And then, of course, you have the possibility of increased fiscal support. Of course, that varies from country to country, but I think that's a tool that we'll see a lot of these African countries turn to should it become clear that these high tariffs are here to stay.
Yeah, how do you weigh up as an investor or somebody who looks at these markets the tailwind that a weaker dollar provides versus the headwinds of the tariff impact that these economies are going to sustain in the next few months?
Yes, it's very much a double-edged sword, and particularly for these African countries, because they're highly export dependent. Actually, a weaker dollar will help in that regard. So there is positives and negatives, I would say, of the trade war. There's a possibility that we see as a result of changes in the exchange rate that should help boost some of these African economies. But of course, that loss of US demand for some of these economies that are highly dependent on the US is going to be a big blow. We're still confident that we'll see those tariff levels come down. We've seen Trump cave to some of his initial Liberation Day proclamations. We think we'll get some sort of more deals here, particularly with South Africa. I think the negotiations will bring that tariff rate down eventually. But there is going to be a bit of pain, a bit of uncertainty in the near term, which is likely to hurt businesses and consumers.
Yeah. Speaking of uncertainty, well, I thought it was interesting that the EU, just in the last 24 hours, are also suggesting that they may delay the imposition of tariffs on U.S. goods by 6 months. Is this just a case of perhaps economic blocs, trading partners are going to keep kicking the can down the road in hopes that maybe this issue is going to go away at some point in the future?
Well, possibly. I think there's going to be a lot of pressure on President Trump when it comes to these tariffs. So far, we haven't seen a huge deterioration in U.S. economic data amid the uncertainty of the tariffs. But of course, we did have Friday's non-farm payrolls report, which was nothing short of a disaster, and has completely changed the narrative towards the state of the U.S. jobs market. So if we continue to see data similar to that in the next few months, then there is going to be a lot of pressure on the president to dial back his tariffs. As I said, we've already seen him take a more softer stance since Liberation Day. And if the data and if markets force Trump to dial back even further, then that's very possible.
Yeah. A final quick one. I see you're in London, closer to home. Bank of England on Thursday, 25 basis points rate cut priced in. Are you expecting them to sound dovish?
Yes, well, we fully expect the MPC to deliver another 25 basis point rate cut. As you said, it's fully priced in, effectively fully priced in by markets. I think the key here was twofold, really. First of all, it's the voting pattern among MPC members. We think we'll see, we won't get a unanimous vote. We may see a three-way split whereby we get a couple of the hawks in favour of no change, most in favour of 25 basis point cut. But the key will be whether or not a couple of the doves vote for a 50 basis point cut. That would be very much a dovish signal. And then the other thing would be whether or not they get rid of the gradual and careful stance in their communications.
Yeah.
We think they'll probably maintain it for now, given inflation fears. But if they were to ditch that, then certainly that would signal faster pace of cuts ahead.
Yeah, for sure. So watch out for the language. Matthew Ryan, Head of Market Strategy at Ebury, really good to have you on. Thank you so much. Well, coming up, we are going to be speaking to the CEO and founder of BlueFive Capital, Hazem Ben-Gacem, after the firm sold a stake to Bahrain's sovereign wealth fund. More on the expansion plans next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Bahrain's sovereign wealth fund, Mumtalakat, has taken a stake in Abu Dhabi-based firm BlueFive Capital. The move provides BlueFive with long-term institutional backing as it continues to scale internationally. Joining us now is the CEO and founder of BlueFive Capital, Hazem Ben-Gacem. Hazem, it's really good to have you back with us on the show. So maybe let's just talk about the stake that Mumtalakat has taken into BlueFive. I speak to people in the industry and they tell me it's actually a really difficult time for fundraising right now, especially LPs turning a little bit frustrated at the lack of realization of gains. Does it help having an anchor investor like a sovereign wealth fund as one of your main investors to help attract other investors in?
Well, first, Jumana, thank you so much for having me on your show. Absolutely. I think today, the historic relationship of LP-GP relationships, I don't think they exist anymore in terms of you just go, you raise a fund, you tap into your investors. LPs, particularly in the Gulf, are more and more looking for something significantly more than just a return of a fund investment, but looking for a strategic link-up where those connections and those relationships will go far beyond the actual commitment to the fund. That is our commitment to Mumtalakat, and we are today already hand in hand working on certain projects together. So that relationship equation between GPs and LPs is fundamentally different, and I think it is led by sovereign funds in the Gulf.
Yeah, that's so interesting. You know, we had at the QEF earlier this year, the managing director of KIA, the Kuwait Investment Authority, Sheikh Saud, he said, and this is a quote, "Private equity is very troubled. Firms have used inflated valuations to delay exits." Do you share that view? Do you think that PE, the private equity landscape, is very troubled right now?
I don't think so. I mean, it's no different from any other industry or sector. There are some firms that are going on a fantastic trajectory. Others have challenges. Others have different business practices. All I can tell you about BlueFive is, although we are 10 months in the making, we have had the most phenomenal momentum, both with shareholders, with management teams, and with investors. So it's very much around your business model, around your corporate ethics, and the way you are going about and what you're offering to those investor groups. In our case, what we have kicked off from the onset is to bring a group of founding shareholders who are today 25 as part of the GP, and we're so honored and proud to have Mumtalakat as one of those. And those founding shareholders, alongside management, are the ones that are contributing and shaping the evolution of this particular asset manager.
On our show, we spend a lot of time talking about the rewiring of global trade, tariffs, so forth, but new geopolitical alignments are opening up. And I do wonder whether for a firm like yours, this opens up an opportunity to get more interest from the East, from the likes of Asia, from China. What are you seeing in that domain in terms of East looking at this part of the world and opportunities?
So, Jumana, the geopolitics of the world today that we see in front of us have been playing over the last few years. More and more, they are positioning the Gulf as a safe haven, not only for capital, but safe haven for trade, for manufacturing, for production. And all kudos to the local leaders, regional leaders, who have played a very important part in positioning this part of the world as a safe haven, not just for capital, but also for trade, and also for one which has a very amicable relationship with pretty much every single country in the world. So that plays a very important part. As an investor. Where do you want to be based? Where do you want to have your businesses active? And I think the momentum is quite solid.
Yeah. Okay. Well, speaking of the Gulf, let's talk about your recently launched GCC fund. You just acquired Wasum. How does that fit into your overall portfolio and into what you're trying to achieve here with your funds?
So, Jumana, first, we are so honored to have been able to raise one of the very large private equity funds ever raised for the region, $2 billion, the BlueFive Reef Private Equity Fund. Wasum is the very first transaction. The two key characteristics about Wasum is, which is very much going to be a DNA of BlueFive going forward, is the vast majority, if not all of what we will do, will be on a bilateral basis, as opposed to being engaged in certain processes and what have you. To do that, you need to have a certain unique access, relationships, but also being able to tap into a certain size and scale that is far beyond what is currently existing in the players. Wasum fits this criteria. It is one of the most incredible and terrific industrial group or holding group in the United Arab Emirates. And I hope that we will pick a large number of, or handful of local champions within the Usum group and develop them into global leaders.
Yeah, last time we spoke, you mentioned that you're looking also at disruption within the financial industry space. What opportunities are you seeing there, and how do you look to take advantage of that right now?
So, Jomana, probably two very, very important two verticals. First of all, around Islamic investment products. This has been an area that has been ignored, and one that there isn't any clear winner into the private markets for Islamic investment products. And I'm not just talking about the GCC. I'm talking about the 1.6 billion savers, pensioners, retirees around the globe, particularly in Southeast Asia, in India, in Pakistan, and many parts of Africa, who are very much looking for saver products and investment products that are Sharia compliant. That's going to be one of the very anchor focuses for BlueFive. I hope we'll be making some significant strides and inroads in the coming weeks. And second of all, around the consolidation in the financial services industry. First, I should say, which is very important, the buy versus build equation is most pressing in the GCC versus the US or Europe. It is significantly, and from a value for money, significantly more appealing to acquire a local player and develop that as opposed to go out and raise a greenfield asset management product. That's why you'll see us acquisitive. The NEO acquisition is no coincidence. It is a big part of that buy versus build program, and I hope we'll be able to announce others soon.
Well, we'll be on the lookout for it. Hazem, thank you so much for getting up early to speak with us. Hazem Ben-Gacem, founder and CEO of BlueFive Capital. And coming up, Tesla approves a $30 billion stock award for the CEO Elon Musk to retain his focus on the automaker. We'll tell you why next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. Well, Tesla has approved an interim stock award worth about $30 billion for the CEO Elon Musk to keep his attention on the automaker. The massive payout comes as a legal fight over a 2018 pay package drags on. For more, let's bring in transport reporter Danny Lee. Let's talk about the purpose of this pay package. Essentially, are they actually paying him $30 billion to make sure that his interest doesn't veer in other directions, i.e. he stays focused on Tesla? Is that how much it costs?
Well, the Tesla board said a deal is a deal, right? And this is relating to a 2018 pay package that fell through because it's been dragged through the US courts. And so this equates to 96 million shares, right now worth $30 billion. But if the original pay package that Elon Musk was going to get several years ago, that could have been worth as much as $56 billion. So for the world's richest man, he could have been a whole lot richer. He's already worth $350 billion, so it's a nice $30 billion extra dollars he can get if he stays with Tesla for another couple of years. But this does really reflect Elon Musk cementing his control of the company. Very much at the time you're seeing falling sales. We're also seeing a share price slide. Yeah. But this is very much for Musk trying to pivot the EV company into something more like AI and driverless tech. So, this could be an interesting signal for other boards and other companies to see what they do to very much reward their CEOs, particularly when it comes to around a key man risk.
Mm-hmm. I was going to say, what's he going to do to turn this ship around? But maybe let me just ask, what's he going to do to turn this car around? Last month he warned about a very rough couple of quarters coming up. What needs to be done for Tesla to reclaim some of that lost market share?
Well, it's precisely invigorating that lineup and potentially putting in more AI and other kind of autonomous features in which, and also putting out a more affordable vehicle. This is all the kind of stuff that Elon Musk has been building towards and will potentially see the fruition of that in the next couple of years. So there's still a long way to go for Elon Musk, who's personally taken charge to revive the falling sales that Tesla has been seeing whilst he's been distracted with the politics. But yeah, this is something to entice Elon Musk to stay with the company for a little bit longer, even as we see a weakness from places like China where shipments have been falling. So very much one to watch as Elon Musk continues to try and turn around Tesla.
Yeah, lots of competition coming through in the EV space as you continue to report on. Danny Lee, Bloomberg's transfer reporter, thank you so much. Well, the theme over the last couple of days, I've got to say, has surprised me, which has been market strength has come through, despite the very weak jobs number we had on Friday, despite President Trump firing the BLS commissioner, more tariff threats, especially the latest tariff threat on India, Switzerland as well, working through their issues too. But look, this is the picture for equities. We've got S&P futures up 0.2, NASDAQ about a quarter, and European markets also seen it opening up in the green as well. I want to turn your attention to oil. We've got two major announcements coming up today from both BP and Aramco, so stay tuned for those earnings. Always a big driver of sentiment in that space. And yesterday, actually, some of the energy names were the big underperformers on the S&P after that OPEC Plus announcement over the weekend to bring extra barrels back to the market. But Brent is just sitting shy of $69, about 0.1% weaker. Okay, that is it for Horizons Middle East and Africa. I'm Johanna Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.